In this week's video, we'll examine the question, are the charts confirming or questioning the bullish case for stocks? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll be covering 5 major charts: the Dow, the VIX, high beta stocks, the Wilshire 5000, and the bond stock ratio. We'll quickly walk through the 1994 example and then compare it to 2016. 1993, where my cursor is, 1995 here, we have a long sideways consolidation period similar to what we've seen between 2013 and 2016, with the Dow going all the way back to 2013. This market went sideways. We know the longer that we go sideways, the bigger the move that we can expect to get. What we don't know if the breakout will be to the upside or the downside. In this case, the S&P 500 was able to break above the box, or what had previously acted as resistance. Then, as we've mentioned several times, it came back and retested that. What once was resistance may now act as support. And if you weren't nervous enough about buying in this region here, it came back for a second retest. And we know the longer a breakout holds, the more meaningful it becomes. In this case, the breakout held for several weeks. And then the S&P 500 took off like a rocket after the 2 successful retests. Now let's take these concepts to the present day. It's a daily chart of the Dow. This is the long-term consolidation box. It was in the box between October of 2013 on the left side of your screen. And this is as of June 27th. You can see on June 27th, things didn't look particularly good. We had not yet exceeded the high from 2015. And worst yet, we had just broken out of a short-term consolidation box to the downside. Then the market took off like a rocket and moved up in a vertical manner and moved above the previous consolidation box. But as of July 11th, it still had not exceeded the highs from 2015. If we fast forward to July 20th, that was taken care of. We get the bullish breakout. And we know sometimes when we get a bullish breakout, we come back for some type of retest. What we don't know is whether or not the retest will succeed or fail. Not surprisingly, the market did give us a scare here on August 2nd of 2016. Intraday, it looks like the breakout is going to fail, and then we come up and close where my cursor is here, basically right at the area of previous resistance. Again, this is August 2nd. As of the close on August 5th, now we can make a case that this is starting to look like a bullish breakout, a retest, and right now it looks like a successful retest. This is a nice looking move off of what previously had acted as resistance. The longer we stay above the orange box, the better for the bullish case. So in this case, the Dow seems to be confirming the bullish move in the S&P 500. Now we'll move on to Act 2, the VIX Fear Index. Clients and regular viewers know that we've been examining this chart with the VIX on top and the S&P 500 on the bottom. VIX support, eventually bad things happen in the S&P 500. VIX support, really bad things happen in the S&P 500. We came down numerous times during this indecisive period and tested it. It looked like we were going to get a breakdown in the VIX here, but that was a false little poke below the line. And as of June 27th, the VIX was moving sharply higher, and it was well above the area that we were watching. If we fast forward to July 8th, now it's starting to look a little bit more bullish for the S&P 500, except we've done something similar in the recent past. So at this point, it does call for some patience relative to reading this chart in the S&P 500. We did eventually break down, and just like a bullish breakout, a bearish breakdown often comes back and tries to retest what had acted as prior support. What once was support may now act as resistance. So on August 2nd, now we're trying to see, will this act as resistance, or will this be another failed breakdown? The VIX holds its support, bad things happen. The VIX holds its support, bad things happen. The VIX does not hold at support, and so far, just as we would expect, good things are happening in the S&P 500. Bearish breakdown appears to have somewhat of a retest here, a successful retest, and now we've gone on to make a lower low. This is somewhat of a trend change. We broke a trend line. We made a lower high here, and today we made a lower low. Like everything we look at, this speaks to probabilities. The longer the VIX stays below the blue line, the better for the S&P 500 and risk assets in general. A lot of times in the market, you feel like you've missed it, but keep in mind, the S&P 500 has been inside of this box for a very, very long period of time. Therefore, it's possible that we are still in the very early stages of a bullish breakout. And even here, you can see somewhat of a breakout and a retest here. And then we went on to print a higher high in the S&P 500. In Act 3, we'll examine high beta stocks. It's a daily chart of SPHB, the ETF world. Resistance, 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 resistance. This resistance goes all the way back to the summer of 2015. Today, on August 5th, prior to the close, 7 minutes before the close, we have what appears to be a bullish breakout. Obviously, this is early, and we're still near an area of possible resistance. But all things being equal, price looks better right now than it has really during any time since August of last year. The longer this ETF stays above this line, the more relevant it becomes. If you're wondering what's in SP high beta, the overweights are financials, energy, and technology. Shifting gears to Act 4, the Wilshire 5000. This index almost helps us indirectly track market breadth. It's a broad index that has a lot of stocks in it, and therefore it can help us with participation in terms of a rally off of a low. As of July 21st, this index was still inside of a long-term consolidation box that unbelievably went all the way back to calendar year 2013 here. The longer we go sideways, the bigger the move that we can expect to get. However, on July 21st, resistance is still acting as resistance. During the trading session on July 29th, we were able to clear prior resistance, but like the Dow, it immediately gave it back and started to take on somewhat of a failed breakout look on August 4th. However, if we fast forward to August 5th and look at the close, we did close above the blue line. So this chart right now also appears to be confirming the bullish move in the S&P 500. The longer it stays above the blue line, the more relevant it becomes. We'll learn something either way. And now we'll move to Act 5, and we'll take a look at several charts of bonds versus stocks. Before we move to the bond versus stock ratio charts, let's talk a little bit about trends and why we use ratio charts. On July 22nd, we showed the charts of TLT, SPY, and GLD all breaking out of long-term consolidation boxes. On July 22nd, TLT, very good shape from a weekly trend perspective. And also notice during this bullish move here, there are numerous weeks where TLT is red. The moving averages are sitting around 135 as of July 22nd. They're in a similar place today. Now we're looking at an updated chart as of August 5th. So we're still in a bullish trend for TLT, and a fair question might be, why would you consider reducing any bond position when it's still in a bullish trend and scoring well on your scoring system? Well, since a picture is worth 1,000 words, let's illustrate. Here is a steady and even and nice trend. This is the percentage change in an investment between March 22nd, 2005 and December 12th, 2006. This type of trend would obviously score well on our system, and if we put moving averages on it or indicators, they would produce favorable and bullish scores. Trend, important. However, opportunity cost is also important. Here's the exact same time frame, March 22nd, 2005, December 12th, 2006. This is the steady trend that we just looked at, which is nice, but over the exact same period, this investment did quite a bit better, 24% versus 6%. So the model looks at the strength of trends, and it also looks at opportunity costs for limited amounts of capital. If we take the same concepts back to the present day in 2016, IEF in isolation is scoring fine in our system. SPY in isolation is scoring fine. This is IEF bonds relative to SPY stocks. This is as of June 24th, 2016. We have the 3 steps for what appears to be a favorable bullish move, a trend change, and a move out of this multiple month consolidation box in favor of IEF. However, at this point, we know that the market has been giving us a lot of false breakouts and false breakdowns. And almost on cue, this breakout came back. At this point, as of June 29th, this looks to be a normal retest of prior resistance, or the orange box. As time went on a shorter term time frame, it shifted to a failed breakout. And as we know, failed breakouts can move sharply in the other direction. This is a relatively short time frame, though, and not a long-term time frame, and it doesn't mean the trend in IEF has been damaged significantly. As of August 4th, now we have a bearish breakdown from this consolidation box, and we start creeping back up in what appears to be somewhat of a retest. What once acted as support may now act as resistance. However, after the bullish employment report, now we have 3 steps in the other direction. We broke a trend line here. We printed a lower high here relative to these highs, and on Friday, the ratio printed a lower low. In fact, price printed its lowest low for several months. Therefore, the model looks at things on multiple time frames. We have breakdowns, observable evidence on some of the shorter term time frames. The trend in IEF still looks good, but we're thinking about opportunity costs. Our question might be, why did we only sell part of our IEF position? Remember, we said the model looks at things on multiple time frames. On a longer time frame, support, it's possible that this market will hold here. We'd like to see what happens next week. We don't have really any particular bias as to what happens. If we move in this direction, we know what we're going to do. And if we move in this direction, we know what we're going to do. And we won't make that decision based just on this chart. It will be made based on the weight of the evidence and multiple time frames. But there's no question IEF looks weaker today than it did at any point over the past few months relative to SPY. A fair question might be, relative to the bullish employment report, how much did market expectations shift on Friday relative to a possible Fed rate hike in the month of September of 2016? That's important for all 3 of these asset classes. An interest rate hike typically would be bad for bonds. It could be bad for the economy and stocks. And in the short run, it could also be bad for inflation-friendly GLD or gold. Market probabilities relative to a rate hike in September did change after the bullish report on Friday. However, they didn't change significantly, nor are they alarming at this point. On Thursday, the market was predicting a 9% chance that the Fed would hike in September. After the bullish number, it jumped to 18%. Sounds like a big jump, but 18% says the market thinks there's an 82% probability after the employment report that the Fed does absolutely nothing in September. Those probabilities obviously can shift between now and that meeting. That's how they look as of August 5th. How did these probabilities look prior to the Fed's hike in late 2015? Did the market get it right? The market did get it right. See it Market Post, CCM, dated November 22nd, 2015. This is before the December rate hike. The market was estimating a 74% probability that the Fed would raise rates in December. Contrast that with the current 18% probability or expectation or estimation for the September meeting of 2016. That 18% figure, all things being equal, is much more favorable than the 74% figure for bonds, for stocks, and precious metals and commodities. On a relative basis, TLT looks a lot better relative to stocks than IEF does, hence the reason why we cut IEF. S&P 500 relative to TLT on August 5th. You can see the last time this ratio made a high in favor of stocks was back in April of this year. Now, obviously, it's knocking on the door as it did here, but the door hasn't been opened yet, so we'll learn something either way, TLT relative to stocks, in the coming days, weeks, and months. You can see the trend, August 5th TLT relative to SPY. We still have an uptrend here, and we'll also learn something relative to what happens for this ratio near what has acted as support in the past. Similar situation, stocks relative to gold. The last time the ratio made a new high in favor of stocks was back on June 2nd. That may change, but right now it's been making a series of lower highs, and this was a lower low. It was August 5th, about 9 minutes before the close. Materials relative to bonds, a chart that we've been looking at for a long time. Also knocking on the door of possible resistance here, but the door has not yet been opened. Some additional information relative to this post on Short Takes, our blog, on August 4th. If you want to find it, you can Google this title here. If you did get a chance to read it, you might remember that there were two quotes, one from 1988 and one from 2016. This quote here from 2016, as we identified in the article, was from a very successful hedge manager, Druckenmiller. With Stanley Druckenmiller's 2016 quote, we can also illustrate some additional important concepts relative to this article. Similar to Paul Tudor Jones and George Soros, Stanley Druckenmiller is one of the most successful hedge fund managers of all time. He was also interviewed in Market Wizards in December of 1991. In December of 1991, the S&P 500 was in one of these consolidation boxes. It had just broken out, and it was somewhat retesting that breakout. So we'll make an assumption that the interview took place on December 15th, 1991. This is what the S&P 500 looked like. Druckenmiller was asked in 1991, "Do you have any thoughts about the long-term economic prospects for the country?" Answer: "I have never believed that the current economic downturn was a recession. I have always viewed it as a debt liquidation, which some people call a depression. It's not simply a matter of a two-quarter recession. It's a problem where you build up years of debt, which will act as a depressant on the economy until it gets worked off over a long period of time. A debt liquidation tends to last for years." December 1991, an incredibly proven and smart money manager. What happened next? The interview took place here. Here's the S&P 500. This is 1992. It took off like a rocket until the year 2000. The key point here is all successful money managers, including Druckenmiller, are highly flexible. For example, in the exact same interview in December 1991, he was talking about George Soros, and he said, Soros is the best loss taker I've ever seen. He doesn't care whether he wins or loses on a trade. If a trade doesn't work, he's confident enough about his ability to win on other trades that he can easily walk away from the position. There are lots of shoes on the shelf. Wear only the ones that fit. If you're extremely confident, taking a loss doesn't bother you. This concept of walking away from a position or taking a loss also aligns with changing your mind on a theory or a hypothesis. All of these money managers, including Druckenmiller, are extremely flexible. Sometimes they may have a quote in the press where they're bearish, and within days, if the data and the observable evidence changes, they may change their positions. The public doesn't know that they did that, but I can assure you 99% of these successful managers are not wedded to any theory, hypothesis, or personal opinion. The vast majority of them use hard data. When the data changes, they shift as well. Obviously, the expression that we use, maximum flexibility, tells us that the market model also is not wedded to any position, any idea, or any hypothesis. Right now, bonds, stocks, and gold all look favorable. When or if that changes, we will also change. That means we may sell some bonds, we may sell some stocks, or we may sell some gold in the future. And that may also include taking a position and then within a day or 2 weeks selling the same position. When the facts change, it is incredibly important to keep an open mind and have the flexibility to change with the data. The key is to get rid of your weaker or losing positions quickly and let your winners ride. Right now, some of these positions look like they could be long-term winners. And the game plan is to let those ride. The ones that aren't long-term winners, no problem. You know you're going to have some picks that don't work out particularly well. You just deal with them quickly and redeploy that capital into a better idea. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.